Show me an option of oh, you're recording. Okay, now it shows me this stop recording. Good. So we are recording it now. That's fine. Okay, so you're still looking at the textbook. Let's look at it. This is still the section where we're doing this. So you see why it's important to have these dynamically updatable notes. That's why I need Google Docs. I can't do this on Creatrix because now we have moved to the. This is sorry later. This is much later. This I was just getting some stuff ready. Okay, here we are on page 13, and we were doing relative performance. Actually, what we're looking at is this. This is how I'm going to denote the chapter or section headings in the book. Okay, so this is the note on Ben Graham by Jason Zweig, which we are looking at. So he's talking about why, just summarizing the investment concepts. Okay, so within that, we have still within the same chapter, we have this. Then we have the next chapter, introduction. Okay, so we talk about page 13 now. Right. So let's look at what he's saying on page 13. So he's just trying to summarize the investment philosophy that allowed Ben Graham to do this kind, to deliver this kind of return over the years, over 20 years. And so you can see here, stock is not just, it's an ownership interest in an actual business. Now you'll notice another thing I would encourage everybody to do is, so I'm just writing this is a separate point, okay? Because this is the book that is recommended by Buffett. Okay, I will just ignore all these spelling cap things. Buffett and Charlie Munger is Buffett's investment partner. Okay, these guys run Berkshire Hathaway is the holding company. Okay, so Berkshire Hathaway I hope you guys have all heard the name. Okay, Berkshire Hathaway. It used to be a shirt company actually. And they bought it. I made a spelling mistake. The ticker I think is BRK. Remember the ticker? Ticker means this is what you type into most. Well, this is the official exchange ticker. So when you're looking at a ticker feed, this is the NYSE I think code for the stock of Berkshire Hathaway. Just like General Electric is GE, Amazon is AMZN. Okay, so you got to get so in India, for instance, Hindustan Unilever is Hindustan Unilever. Okay, so that's what is the official ticker. That's called the ticker. Okay, so this is the ticker for Berkshire Hathaway. We learned this new term also. It's called the ticker symbol actually. It's called the ticker symbol. All right. So what you got to listen to is all you guys have to go to YouTube and listen to the Q&A during. Excuse my all caps typing. Okay. I hope it's not a big problem for you folks to look at this. Okay, so because we don't normally read text, which is all caps. So Q&A during the BRK AGMs. Okay, AGM. What is AGM? Anybody? What is AGM?
Annual general meeting.
Correct. Okay. So Berkshire Hathaway, publicly traded company, so they have to hold annual general meetings. These AGMs. You can find this stuff on YouTube. Okay. Go and look at it. Q&A sessions, Buffett, just do Buffett Q&A, AGM, etc. So just do a query on YouTube. You'll find a lot of lectures. Okay, you find a lot of lectures. I try to put some of the lectures in a sheet for you because I've also saved them up. And you'll find that he's talking this kind of thing. You can understand why Buffett is recommending this book. This is what you'll find Buffett saying all the time. That it's actually is an ownership interest in an actual business. Okay, an operating company. So there's a heavy focus in value investing, and the heavy focus on understanding the actual nature of the business. What is the competitive advantage? What are the dynamics, all the cost and revenue dynamics of the business in great detail. So understanding the actual business is the point that. So this reminds me to sort of put this pointer in about because Buffett keeps talking about it. Okay? If there's some background noise, just ignore it. Okay. Now. You guys have to do this, okay? So this is again, as I told you, I think I told you this during your lab as well, maybe, that the way we function here, especially the way I teach the finance electives, is that the domain is so vast and the time we have is so limited that I can't even think about teaching you everything that you need to know. So even at this stage of your career, so I can only teach you a little bit based on the number of hours we have and maybe some tutorial sessions. But what I will do is basically, so I think of myself as your coach. So I will work with you on certain things in the class on a live basis. But most of the time, I'll be giving you pointers like, okay, this stuff, this is your point. Now, I don't have time to discuss all these things with you. Okay? It's your responsibility to run with the ball. I gave you this pointer, so that's what I do as a coach or a guide. I tell you where to dig, and then you have to dig. Okay? So that's the advantage of having a coach or a mentor or a teacher, because that person tells you, because they have more experience and more knowledge, they can tell you where to dig. Otherwise, you'll be just madly digging here and there and not knowing the right places to dig. So here you have to dig, and that how much digging you do, that's your totally up to your initiative. Okay? And that's the amount of learning that you will derive based on the amount of digging you're willing to do. So this is what happens here. Okay, so I'm going to give you pointers. Think of me as your coach, and I'm giving you pointers. You've got to work on it on your spare time, in your spare time. Okay? So that's one point, okay, about this. Now let's look at the second point. The market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. Yes, okay, you understand that. Okay, so let me just take one more example. How many charts we have? How much? This is not. Let me take this from the link I gave you yesterday. That So this is the comparison chart that we had yesterday. Let me see how much data. I'm going to remove this. Okay. See how you operate. Just tinker around with this stuff. Okay. What I do is I make this. Let me make this once again. Take Dow Jones Industrial Average and let's see which one has more data. If I go to all, so it's a fair amount of data. Okay. So why did I want to go there? The market is a pendulum that swings between optimism and pessimism. So optimism means stocks are too expensive. I'll explain these terms a little bit later on. But so obviously you can see this is a fairly obvious thing. You can see these big swings. Okay. Here you can't even see. This is the 87 somewhere around July, October 87. This is that I told you about the Black Monday crash. So when you see the long-term chart of the Dow, you can see how the Dow is very much like the Sensex. Okay, the Dow is only 30 stocks, industrial stocks. The Sensex is also 30 stocks, and so it's a narrow index. It's a very narrow index compared to, let's say, the BSE 200 or the Wilshire 5000, I think. Or so these are broad-based. Those are broad-based indices, and the Dow and the Sensex are narrow-based indices. Even Nifty would also be considered fairly narrow because only 50 stocks. You can see in the context of the long-term movement how insignificant. I would actually forcibly have to point it out to you when the October crash is. Okay, here. So you can barely see it on the long-term chart, but when it happened, it was the biggest single-day point drop in history. So it was a major case of panic for the markets, and people still refer to it as Black Monday. But you can see these big swings that are happening. Okay, this is actually what is called the internet bubble in the mid-90s, where all these stocks, that time Amazon wasn't making any money, but it was going up a lot. Pretty much anything with a .com behind its name, it's sometimes called the .com bubble. So anything with a .com behind its name was going up, and this is the peak around 2000. So you can see end of 1990, 2000 is the peak of the .com bubble, and then you had the crash up until about 2003, December 2002. So this is basically when the ultra loose monetary policy began. Actually, very weak, very soft posture on monetary policy. So Alan Greenspan was the chairman of the Federal Reserve at that time. So you can see this excessive optimism and then pessimism, and then it starts to come down. But Alan Greenspan at this point is already trying to prop up the economy. What you see today also with the Reserve Bank of India and all the other central banks, desperately trying to prop up the economy with low interest rates. So already at this point, as the market was, the internet bubble was had burst and it was crashing down, and the central bankers were, especially Alan Greenspan, was trying to prop up the economy and the housing market, etc., with ultra low interest rates because he wanted to promote home ownership. Can you imagine how ridiculous that is? A central bank chairman trying to promote home ownership. It's not his responsibility. His job is to control inflation. In the US, they have two mandates. control inflation, and create a positive environment for growth, promote growth. Okay, so it's a two-sided mandate, but there's no home ownership in the mandate of the Federal Reserve. But this guy is so over smart, and this is what happens when you have all these elites who think they're the end of the world. So this guy started this policy of low interest rates, and then you had all kinds of other regulatory problems also, where there was a moral hazard being created. There was an incentive for the private sector to generate lots of mortgages, in addition to Greenspan keeping the interest rates low. So housing loan rates were low, and this guy kept, and the mortgage generation incentives were there from the government. So the private sector kept on generating all kinds of junk mortgages, and then you had the housing bubble. So this is the internet bubble in the mid to late 90s. Okay, then crash, comes down. Then you have really stupid monetary policy and really stupid government regulation, trying to basically encourage home ownership. That's not really the job of the government as well. You just leave it to the free market. But because of this, now you have the housing bubble. Okay, so house prices start going up. You have the housing bubble, massive generation of mortgage-backed securities, all kinds of derivatives on top of that, credit derivatives, massive explosion of the derivatives market, because the government is incentivizing you to create these mortgages. Just like you have, you see the bank fraud in the Indian system. Why is there so much bank fraud? Because it's all government owned. So it's nobody's bothered because it belongs to the government. Nobody's skin is burning when the money is lost. So it's the exact same kind of incentive problem. Massive boom in housing prices and lots of malpractices. You have the 2007. This is when it starts to go wrong. June, July 2007. And then you have the 2008 crash here, September 2008, Lehman Brothers bankruptcy, the major global financial crisis, etc. Okay, comes in here. And again, the central banks now are really scared. I mean, here only Greenspan wanted to promote home ownership and was practicing ultra loose monetary policy. And here, all the central bankers went crazy, including our Reserve Bank. Okay, everybody started to pump money into the economy, ultra low interest rates. Okay, so what you're doing is you're discouraging savers, and all this stuff happened. And then, of course, the same story, we are living through this. Okay, barring the little COVID blip here. So if we follow it from say 2009, and if we take for 5 years, we'll not do it. But you can see, we go from 2009. You can see this thing coming up. So this is, that's 2009. That's the base of the global financial crisis. That's the low, and from there it's going on. Okay, so you can see this, and well, of course, it's so we get here. So this is where you see the movement again. So again, it's going up. Now from here, the monetary policy is very, very loose. It's looser than it's ever been. Okay, and then you have the COVID blip. Okay, the fear in the market because of the COVID lockdowns. And then you see how quickly it has reacted again, okay, after the COVID lockdown. So this is what is, so in response to a very small statement, I showed you a lot of, and I gave you a long lecture on economic history, especially this, financial history of the US stock market, which kind of gets reflected all over the world. But this is important to know, okay? So this stuff that I told you, this is, important for you to know. And please make sure you understand all the elements that I gave. The internet bubble. So go back and play the lecture multiple times till you understand it clearly, because you haven't really maybe heard about or read about it. You're hearing about it for the first time maybe in this much detail. So make sure you understand all the elements that I talked to you about. Okay, the government incentives. Incentives are the biggest problem. Okay, I should tell you the statement here. Very important.
Sir, according to the chart that you showed, we call that 1929 is the Great Depression, but that was nowhere, means in the chart did not show that much significance as compared to what we what we call 1929.
Yeah. It doesn't look, see, because now the movements have become much more volatile. Okay, so in the light of the volatility of the current movement, there's another way to do this. Actually, I haven't done the scaling here for so long that I've forgotten. I might be able to show you this, and you learn a little bit about charting. Okay, if I go to scales, and normally what happens is if you are faced with a situation like this, okay, that 1939, well, actually 1929 is the stock market crash. Okay, yeah. So it's around this time is the stock market crash, but this can barely be seen. It looks like a straight line, just like October 1987 stock market crash. It can barely be seen. Okay, because the movements now have become so volatile and the market has moved up so much. This is called the linear scale chart. Okay, so in the linear scale chart, so we're learning a little bit about charting. Okay, so we should make a note of this. And where should we make a note of this? Okay, fine, we'll make a note of it here only because it's happening in the context of our discussion. What is the point I'm talking about? Market is a pendulum. So we'll just give this as a, what did we say? Market is a pendulum? Yeah. Market is okay. So you know what the context is. So in the context of that, I gave you this discussion. And then we talk about, what is the point I was mentioning? Okay, chart scales, okay? Chart scales. So also something to learn, okay? Linear versus logarithmic. So I'll just tell you briefly what it is. You can understand. So I'm not going to write everything. That's why the video becomes important. Because if I have to write everything, it will slow me down. Okay. So this is linear. What is the characteristic of linear scales on a chart? You have to be very familiar with this because as a financial markets professional, you are going to be using charts all the time. So equal distance 0 to 5,000. The physical, let's say this is 1 inch. Let's say for the sake of argument. Let's say this is 1 inch, 0 to 5,000, 1 inch. Then 5,000 to 10,000 will also be 1 inch because equal absolute movements will have the same will occupy the same physical height, okay, or the distance. So 0 to 5,000, same 1 inch distance, 5,000 to 10,000, 1 inch distance, also 1 inch here, also 1 inch here. Now, let's go to logarithmic, okay? Let me try and change the scales. Where is the option for logarithmic scales? That's the point actually. I've not used it for so long. It doesn't seem to give us, normally we have the option here. Let me see sometime. Okay, let me try and show it to you through Yahoo Finance, okay, what it means. Okay. I'll show you one minute. Let me just load that chart on the other side. And this is Microsoft. And it's the chart. I'll bring it here, then you can see what I'm talking about. I don't want so much actually. Is there an option here for scale? Yeah. So you can see logarithmic scale. What happens in logarithmic scale is, yeah, you can see this. So the difference in the case of a logarithmic scale, if we have max data on a logarithmic scale, you can see it much better. Okay, in the case of Microsoft, right? Look at this one. So let's do it this way with this. Okay, so this is max data for Microsoft, and you can see it now on a logarithmic scale. But let's first look at the characteristic of a logarithmic scale. I'll increase this for you to see better. Okay, what is the characteristic of the logarithmic scale? So equal percentage moves will occupy equal physical space. Not equal, earlier I was showing you equal absolute moves. Maybe here. This is equal absolute moves will occupy same space on the chart, on the scale, the physical space. And this is equal percentage moves, okay? This my cursor is moving around. Okay, I don't need that. So this is where it is. Actually, this is not the full data because it's gone up higher than that. So anyway, so this is, that's why I don't need 5 years of data. I mean, I don't need all the data. I can just use 5 years of data. Okay, and make it smaller. So you can see this a little better. 5 years of data. This is on a linear, on a logarithmic scale. So equal percentage moves will occupy the same physical space. Okay, that's the rule of a logarithmic chart. So what he could do, for instance, what we could do here to show, if we change this to, unfortunately, DJI. This is something you learn. It's a useful question. The question is a good question because it allows us to learn this. And that is what we are learning is that let's show a line chart. It makes it life simpler. Okay, let's show a line chart. Let's have a full screen chart. So we're spending a little bit of time on charts, but it's important because you need to be able to use charts all the time. We have Dow Jones. Let's see what happens if we do max. Okay, they don't seem to have that much data. See, they don't have that much data. So their database is actually much worse than you can see. Their database starts in 1992. But even then, this is a logarithmic scale chart. It's logarithmic scale. So you can see that you can see a lot more detail. Now, if I change this to linear, you will not see a lot of detail. This is not, it's easy to see on the long-term chart. If these charting applications are not behaving very well, especially this Yahoo Finance has been misbehaving for a while. But the short answer is that this problem, sometimes you can solve it by using a logarithmic scale. Okay, so here I've forgotten where the logarithmic scale is. Okay, so because I don't use logarithmic scale. I don't really believe in it. Sometimes you have to do it when you're looking at long-term trends and you want to see the shape of the pattern and you can't see it here, then you can use logarithmic scales. Okay, so that's the point to learn about. Chart scales, linear versus logarithmic. Okay, this is one point. Now on the market is a pendulum. I discussed. So does that answer your question? Who was that? Sanchit who asked that question about 1929, the Great Depression?
Mayank.
Mayank. Okay. So Mayank, are you satisfied with the answer? Although I couldn't show it to you because we don't have the data here, and I've forgotten how to.
Check once. I will just see it once.
Yeah, you check it and practice and just tinker around here where the logarithmic scale. You saw how I did it on Yahoo Finance, so it will be in one of the settings there. Okay. That's the way to do it. Okay, when you can't see the details, you can try to do it on logarithmic scale, and that might help you. Okay, so there's a learning here even from this question also you can see. So we're not doing it traditionally. Like in a lot of places, what might happen that when we are following the textbook, we will just follow the textbook, and the teacher will not really entertain questions which are outside the obvious scope of the textbook. So in this case, my expression, I say we'll discuss it later or something like that. So, but I believe that the most important thing in the class is to deal with student questions, even if they're not directly on the point which is in the textbook, because that's why students come to class to ask questions. Okay, so I think that's my personal philosophy. So we go like this. So some people might find it unacceptable because they're saying that, okay, we are dealing with some question from here and there, but we are not following the textbook. So that's also a legitimate point of view, but I'm explaining why I'm doing it this way, because this is my personal philosophy, that answering the student questions is the most important thing. And the questions are all kind of related. It's not like it's totally unrelated, like he's asking me how to bake a cake and all that. So they are related questions, so there's something to learn there as well. Okay? So market is a pendulum. So I gave you this lecture. Please make sure you go back, play back the video and listen to my lecture and what I said about all these different internet bubbles, crash of the internet bubble, the bursting the internet bubble, then again the housing bubble, the global financial crisis, going up, then COVID and up again. Okay? So you can see all these big swings of sentiment. And so what he's trying to say here is really that swings between unsustainable optimism and unjustified pessimism, okay, which makes them too cheap. Okay, so this cheap and expensive is relative to this guy's assessment of value. Okay, I'll explain what that means, but remember that. Okay, this too expensive and too cheap, these are subjective statements. I'll explain this. Okay, but this is basically swinging between unsustainable optimism, making stocks too expensive. So if you remember, of course, you don't have that much experience, but I was in the market at that time. So I was already following one. So I started work in June of 1990. Okay, so this is when I entered the market. Okay, so of course I started out as a foreign exchange trader, but I was following all the global markets, equities, commodities, bonds, etc. So I knew what was going on. And at this time, what was happening already by the late 90s, Berkshire Hathaway was already not doing they were not basically participating in the internet boom because according to Warren Buffett, the stocks were already too high at this point. The prices were too high. So what he was saying is this is what Buffett was thinking at that point of time, because he was always talking in the media. He was talking about how stock prices are too high. And Buffett very famously did not participate in this technology boom. This is also known as a technology boom. Okay, internet bubble, so it's mostly technology stocks. And Buffett did not participate in this rally And he used to always talk about stocks being too expensive. Okay? And so this is the kind of thinking that Buffett was employing. Okay? You can see that this book is it's a book on value investing, which is what Buffett practices, and that's why he recommended this book. And you can see in his own lectures, you will see the repetition of these principles. And then again, stocks are too expensive. So here's one of those examples: the internet bubble, where Buffett himself did not participate, right? And he watched it go up, and then of course, many people made a lot of money also. If you went in and out and you could get out at the right time, you could make money as well. So this is basically what it means. And then unsustainable optimism, which makes stocks too expensive, which is we're talking about over here. And anything with a .com, there are actually companies at this point of time which changed their name to .com. Like they just added a .com. So if you have like a company called Haldiram, then they suddenly change their name to Haldiram.com. So it's like you get a value premium if you try to put a .com against your name. So it was that crazy actually at that time. So then you have, this is what is called unsustainable optimism. And then of course the crash comes, and then by this time everybody is burned badly, and then nobody wants to invest, and everybody is really pessimistic. So that's what he's talking about here. And unjustified pessimism, which makes them too cheap. So stocks are too cheap. Cheap and expensive, remember, is always relative to something. So which he has not mentioned here. So what is silent here is too expensive, too cheap, relative to the writer's perception of value. Okay, we'll come to this, price versus value. Remember that too expensive, too cheap is never good enough, because there's always something implicit which has been left out, which is the benchmark that you're using. I can say Mukesh Ambani's house is too expensive, but for him it's not expensive. But for me it's expensive. So it's just that the benchmark is different. So relative to my assessment of what a house should cost, his house is too expensive. Okay, but obviously not so for him. So this is basically what is meant: optimism and pessimism. Optimism, again, housing bubble, and then the global financial crisis, great pessimism, central bank starting ultra loose monetary policy. Again, you can see COVID pessimism, and then again rising up here and blasting right through the COVID pessimism, mainly tech-driven rally, but happening in the Dow Jones as well. Actually, it's all basically at this point of time, it's all monetary policy driven, because monetary policy is so loose. There's so much money flushing around, and the central banks have essentially told us that they will never allow a recession, a big-time recession, to happen. In terms of, at least from the monetary policy side, they will keep on pumping money into the economy. So what that has done is that it's given people a lot of courage. I mean, if you know that you're never going to die, so you will obviously become much bolder. So that's what is happening here, and that's partly, according to me at least, that's partly the explanation. And many others in the market will say the same thing. That it's a liquidity-driven rally. It's also a kind of a Federal Reserve guarantee-driven, central bank guarantee-driven rally. Central banks have guaranteed that when the market crashed like this over 5 years, when the market crashed like this, they started doing crazy stuff like buying private company bonds. Okay, just pumping money, giving people stimulus checks. I mean, they just went crazy. So they're never going to allow a big drop in stock prices. So if you know that stock prices can never drop that much, then obviously you'll buy stocks like crazy, right? Whatever money, and then so that's happening. Very bad behavior, according to me. Very bad management of the macroeconomic environment, and eventually we will all pay the price for this. I mean, this utter stupidity on the part of central banks. That they're pumping so much money into the economy. Eventually, we'll all pay a price for that. So not much we can do, of course, because I'm not. So anyway, so this is basically the thing. You have to remember all this. Okay, this is very important to understand history, and you'll see that again. So this is basically what he's trying to talk about here. And so the intelligent investor is a realist who sells to optimists and buys from pessimists. What does that mean? That what this guy wants you to do is to be a seller at these levels, at high levels, when you feel the market is overly optimistic and share prices are relatively much high, very high relative to your assessment of fair value or value. You should be a seller. And here, when you feel that market prices have declined too much and the market, then should be a buyer. Okay, so try to understand the statement. The intelligent investor is a realist He's not an optimist or a pessimist. He's a realist, and he sells to optimists and buys from pessimists, which means saying that your goal should be to sell at the market near the market tops and buy near the market bottoms. Of course, it's not so easy because you don't know when this is going up. You don't really know that this is going to be the top. So it's a good philosophy to have. That's fine, but putting it into practice is a problem because you never know where the bottom is. Okay, you might go in somewhere, you think that this is, you might have got in here, and then it keeps on dropping. So what are you going to do? And this problem can never be solved. Okay, so but this is the idea. At least try to understand what he's trying to say here. Okay, so that's the idea here. Okay. So that's the second point. Now, third point. So far, I've been very much in lecture mode, but still, thankfully, we got a few questions. That's very important. Keep asking your questions. So that way, at least I know that people haven't fallen asleep. Okay. Future value of every investment is a function of its present price. Higher the price, the lower the return. Okay. Again, from small sentences, you can see how we are able to cover many different ideas because they are connected, actually. All right. So market is a pendulum. I gave you a lecture on economic history based on that. Now, if we look at this, I don't want here. This on this side. So I'm swinging between the book and the notes. Okay, future value. Now let's put it this way: the higher the price, lower the return. Here also, we are going to make a. I should first discuss price versus value. Okay, so when he talks about this, actually, yeah, it's the same thing. It's part of the market as a pendulum discussion. Okay. Now let's have this here like this. Okay, so let's call this price versus. So in the law we write V. Okay, V supply price versus value. V this is value. Okay. So value, I want you to learn this term also called fair value. Okay. Fair value means this is fair. It's not too high. It's not too low. It's fair. Okay. So I give you C in the course, but based on your performance, that's a fair grade because it reflects the work you did. Okay. So this is price versus. You should also learn this term. These are all terms that we use in classical finance. So remember that you're a finance student. Okay, you're not just a layman anymore. You're a finance MBA student. So which means you have to be able to talk. You can call it jargon if you like, but it's important to know what the technical terms are in finance and to talk in using the technical terms. Okay, so you have to be clear about these concepts. So we use the term fair value, and sometimes we just say value. Okay, so price versus fair value, and here I've given you. This is for your future work. Okay, this is a professor called Ashwat Damodar. You'll see one of his textbooks, many of his textbooks actually, in the. Okay, so this is the Zomato valuation. So this is a good text. Go and subscribe to his channel. He's actually teaching at NYU. You can see his courses. The courses are a little bit theoretical. He spends too much time, I think, on valuation in nitty-gritty and the intricacies of valuation, which don't really matter much. But what is very interesting on his website is very often he does case studies, little case studies, valuation. These things you should try and do. He's done one for, I think, for Solar City, the Tesla acquisition of Solar City. So dig around on the website, on his YouTube page, where he is covering specific transactions and specific companies. Okay, like here you have a valuation of Zomato. Try to go through this and try to understand it, and you'll get some and try to practice along, etc. Okay, so that's one thing. You can find his textbook on valuation in the library as well. But I guess, as I said, the textbook is not so important as long as your basic concepts are clear. But the practice of putting it into practice through actual case studies is an important lesson to learn. And so I've given you that link. Okay, valuation, because I'm discussing price versus fair value. So what we will discuss, so one is basically price versus fair value, and that we can say is okay. So price versus fair value. Let me first explain what is price and what is fair value. Okay, I don't need this anymore. You can do it yourself. Right. So price. Let's go to a shorter chart. Okay. Let's look at. It just had earnings. Who's it? Okay. So Facebook. Okay. So what is the last price? See, right now we are in the U.S. markets are not open. So the price of Facebook is 363.5. Let's say 364. Okay, rounded. So now this is price. Okay. So if I ask you what is the price, what is the closing price of Facebook in New York last night? Today is already Saturday, so it's a Friday, right? And so the answer is 363.51. Okay, so that's price. Now, when he's talking about market pendulum, market is a pendulum swinging between unsustainable optimism, making stocks too expensive. What he's talking about is, again, going back to, maybe if I go back to this is the Dow Jones. Actually, Dow Jones is not the right, you want to go Nasdaq composite. This is Nasdaq 100 actually. Let's do Nasdaq 100 since it was a tech bubble, and I'll show you. Yeah. So now these also here also these guys don't have that much data. There you got some data. Good. Yeah, you can see now that you can really see the tech bubble. Okay. Of course, this is not complete because now it has gone through that. Okay. But if we go back, and I don't know how I lost that now. Anyway, yeah, okay, like that. That's how I get it. So you can really see the the entire tech bubble of the starting off in the mid to late 90s. Now here, so what was I trying to explain here? Yeah. So when make stocks too expensive, now what is value here? So what he has not stated here is this sentence has to be read like this, okay? And I'm not going to be writing it, so that's why the video is important. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive relative to my estimate of fair value. Okay, this is how you read the sentence. The implied words which have been left out here are too expensive relative to what? It has to be always relative to something, relative to my estimate of value or fair value. Okay, so that's what is meant by the statement. And so when I talk about this here, so when stocks are going up, why is Warren Buffett not buying? Why is it at this point in the in the 1898, 99 was really the real stratospheric rise in stock prices and tech stock prices especially. Why is Warren Buffett not buying? Because according to Warren Buffett, the prices are too high relative to his own estimate of value. Okay, that's basically what it is, right? So, so we'll come to what value is, but the point is that value is some. You can see here this first statement. So we're actually covering all the principles of Graham as a summary right at the beginning itself. Okay, here you get many of the important concepts just from his summaries. Actual business with an underlying value that does not depend on its share price. Okay, so this is where we are talking about price versus fair value. This is actually this should be based on here actually. Actual business with an underlying value. Let me put this in here. This discussion of price versus. And then we'll have the discussion. Now this actually is here I think it's really small caps. Show that it's coming. Actual business with an underlying value. Okay. So that's where we are having this discussion of price versus fair value. Okay, that's the quote there. Now, so when he says that this quote has to be read as actual business with an underlying value that does not depend on its share price. So here straight away you have the idea of the fact that the price and the value are different. So when I showed you what is the price of Facebook, pretty simple. Just look up Yahoo Finance, this chart, 363.51, closing price of Facebook in New York on Friday night. Okay, pretty simple. Now, what is he saying? An actual business has an underlying value that does not depend on its share price. So what he's straight away telling you is that this share price is not the whole story. This share price is not the whole story. You have to look at the underlying business that Facebook, the stock represents. It's an ownership interest in the underlying business. You have to look at the underlying business, and you have to figure out the value of the underlying business, which is not related to its share price. Okay? It's not dependent on the share price. So it's just something different. Okay? So that's where you get this concept of price versus fair value. Okay? Value, price versus value. So, and then the whole concept of valuation, okay, which is about basically what is valuation? Valuation is the process of arriving at your estimate of the fair value. Okay? So now, who's going to tell me? I've put in two other words here. Price versus value is one word, and subjective versus objective is another word. So who's going to tell me which matches which? What is price objective or subjective? Is value objective or subjective? Who's going to tell me? Anyone? Is my question clear? Yes, is my question is clear? Yes, who's gonna say like?
So
let me
price is objective and fair value is subjective.
Okay, and can you expand a little bit on that? Why do you say price is objective? What do you mean by that? When you say price is objective, what do you mean by that? Can you explain further?
Yes, price is what we actually just like we saw the price of the Facebook share price.
Yeah.
Okay, and it was at a one glance we found the price of the Facebook share, and fair value which would be associated to the business which Facebook is into. So that would be assessing the business model of the Facebook.
Okay. All right. Okay. So
price should be subjective, right?
Who's saying price is subjective?
Sir Rahul, shouldn't it be?
No. Why do you think price should be subjective? You understood what I meant by price. Okay. Forget about what you understood by price. This is what I told you is the universal definition of price. That if I ask you what is the price, what is the closing price of Facebook, or at any point of time, if I ask you what is the price of Facebook, you go to a charting system or you go to a website like this and you talk about just enter Facebook and you see the stock price, the shares of Facebook, price of Facebook shares. Yeah. So why are you saying price should be subjective? What makes you think it is subjective?
Sir, I'm not too confident, but sir, price can be like influenced by the personal feelings. You know, when
okay. Yeah, I get what you're saying. Yeah, don't worry about being confident. I mean, here in our class, we're all in a team, so that you have, even if you have a slight doubtful view of something, you say what you think is what appears to be true to you. Okay?
Yeah,
there's no penalty for being wrong. Okay, so actually, what you're talking about is not the price. You're talking about the process of determining the price through the interaction of different investors. Okay, so you're not really talking about the price. When I say price, is it objective or subjective? I mean this kind of price. That's why I gave you the definition first. That by price I mean what is the price of Facebook now, or the latest traded price of Facebook. Okay, I don't mean the process. You're talking about the process, and you're right about that. That the process of arriving at the price is subjective. I mean, there is subject, or let's not put it this way. Let's reword the sentence and say that there is subjectivity built into the process by which the price is arrived at, because the interaction, I mean, the decisions of investors to buy and sell are based on subjective consideration. Have I interpreted correctly what you're trying to say? That's what you're trying to say, right?
Yes, sir. Yes, sir.
Yeah. So actually, what you were talking about is not wrong. What you're saying is not wrong, but you're not really talking about the price. You're talking about the process by which the price is determined. That contains elements of subjectivity because that's how investors make their decisions. Okay. So you're not wrong. It's just that you are not answering the question that I asked. Okay.
Can I add some view?
Yeah.
Sir, as Rahul said, ki emotions drives the price of.
Yeah.
So there are so many investors. The majority of investors works on the fundamentals.
Okay.
So that's why they are in the share market performing good.
Okay, so you're supporting Rahul's statement, and you're saying you're explaining why Rahul has said what he said, right?
Yeah. No, sir. Actually, I want to say
Your voice is actually it's your network poor. Your voice is cracking up a little bit.
yes, sir.
Yeah. Okay. Anyway, try to speak. Whatever. So you're on mute. Yeah.
Sir, I will write in on the.
Okay. You're writing in the chat box.
Yes, I will ask you after the class.
Okay, fine. You can ask after the class. Okay. By the way, the after class discussions, please remember those are also part of the syllabus. Okay. So yesterday, like Isha stayed back and she was asking some questions, which were important questions actually. So I answered some. So you have to listen to the entire recording. You can't stop at the time. I'm not going to detain anybody after the official class hours because I respect your need to make plans and know that the class will end at a particular time, but you have to come back and listen to the video and the entire all the discussion. So if I have some discussion with Sanjit today after the class, that becomes part of your syllabus. Okay, whatever I discuss there, so I can ask you questions from there. So you have to listen to the entire video. All right, so we'll do that after the class. Fine. So let's understand. Maybe once I go through. So Isha is correct actually that price is objective and value is subjective, and I'll explain to you why value is subjective. Uh, and we'll see. So price is objective because this answer to this question, there's only one right answer to this question. If I ask you, what was the closing price of Facebook in New York last night, or what was the closing value of the Nasdaq index? You can see it here. Okay, Nasdaq 100 index. What was you see at close 5:15 Eastern Daylight Time? Okay, so that's the closing time for New York trading. The 15. This is the price of the Nasdaq. This is the value or the level of the Nasdaq 100 index on Friday night. So there is no second answer for this. This is the only correct answer. And so then and we have a thermometer room and I ask anybody in the class, so everybody look at the temperature, the thermometer, and if I ask them what is the temperature in the class, everyone's going to say 37 Celsius. There's only one right answer. That's why it's objective, because everybody will arrive at the same answer. So the main thing about objectivity is everybody must arrive at the same answer. If you are correct, of course. But of course, if you don't read this correctly or you don't know where to look, then you'll have the wrong answer. But you understand now what is meant by objective. Okay, everyone has the same answer. Let's put it in brackets here so that a little bit, I'm taking some liberties with the English language. I'm not writing grammatically correct sentences because our objective is here to just have some short notes. If you don't understand anything in the notes, like I said, about everything else in the course, it's your responsibility to go through the notes and point out to me that, I'm not able to understand this part, then I'll write a little bit more and maybe clarify it, okay? But if you don't tell me, then I won't know, okay? I'm using my own judgment and trying to clear it up from time to time and add more resources. But if you have a problem, you have to inform me, okay? And then only can I clarify that. Okay, all have, let's put it this way differently, all likely to have different answers. Okay. Now, if we go back to your, let's say, sorry, trying to get something here. You guys remember you did a Gordon growth model for equity valuation in your first year? Anybody remember? Now you've forgotten everything. What happened? You've forgotten everything. What? No one can hear me.
I can hear you, sir.
You can hear me, but you have forgotten. You have forgotten the Gordon growth model. Okay. So 1 minute. Let me put this. What is meant by valuation? Okay. Why is value subjective? Now you understood why price is objective. Okay. Now let me show you why value is objective. Okay. Let's put this picture in place. Later on, I'll give the edit. lower this a little bit. So later on, I'm going to put the. Please remember when you're using, because I didn't want to have to write all this algebra stuff by myself. So I just copied it from one of these websites. So later on, I have to put the credit here, taken from, etc. Okay? So I need to do that. Okay. So please remember to do that. Just copy the link address. Okay? So I should write it. So otherwise, it becomes plagiarism. So not exactly APA format and all that, but at least I've given a source. Okay. I'm not just stealing it. So please remember to do that all the time. Okay, so look at this now, Gordon growth model. And what we're trying to show you now is why is value subjective? Okay. Now suppose I ask you now, you just saw that valuation of Zomato, right? You see the valuation of Zomato. Now, what he's doing is a valuation exercise for Zomato. He's not talking about the IPO price. Remember? So Damodaran is one of those people who is very particular about keeping the difference between price and value clear. He's doing a valuation of Zomato. So he will use his own subjective assessments, and he's not talking about the IPO price. IPO price you can find out. Just go and read the market reports, and you can find out what the IPO price range was and where the price was finally set. That's objective data, because the IPO is over. This he's talking about valuation. Okay, so look at this. Why is value subjective? Understand this. Okay. Now you guys remember, please give me some people at least should sound yes, 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 yes. Now you recognize this.
Yes, sir.
Yes. Now you recognize
Yes,
this.
sir.
You did this. Did you
Yes,
do this
sir.
in your first year? Yeah. Okay. Good. So now you have forgotten everything. This is not going to work. You need to make sure you are clear about your first years, especially your financial statement analysis. Okay. This kind of valuation exercise, which is there in this video, plus all your financial statements inside out. You should be able to do financial ratios, balance sheet analysis, okay, all the financial ratios, different operating effectiveness, efficiency ratios, valuation ratios, then profitability ratios. You should be able to do this stuff with your eyes, blindfolded with two hands tied behind your back. Okay, that's how fluent you have to be in all this stuff. Okay, you should be living, breathing this stuff. So you can't forget all this stuff for what you learned in the first year. Okay, now one. Yeah, okay, so look at this stuff now here. Now this is actually not, this P0 is not correct. Actually, the P0 is not correct. Based on what you remember, you did this exercise, right? Based on what you remember and based on the context of the discussion that we are having now, we are talking about the difference between price and fair value or value. Can you complete my statement? I'm saying this price here is not the right term. What should the term be over here on the LHS? Can anybody complete my statement? If my question is clear, you know what kind of discussion we are having. What is the context in which this thing has come up? Okay, now I'm giving you a Gordon growth model. I already told you now. What should be, I'm saying this term price, P0 is the price. Okay, this is not the correct term because obviously it's P0 because they mean it to be the price. But what should have been the term, the correct term here?
V0.
V0, correct, very good. Okay, so it should have been the value. It is actually value. So what this LHS is actually, this should be the fair value. Either fair value, we can just call it value. So that's the correct answer actually, V0. It should have been V0 to indicate value. This is not price because you don't need all these fancy models to figure out the price. You can just go to a charting system and see what was the price or what is the price. These are real-time charts. And I think they get this exchange gives you free real-time data. So this charting system is likely to give you free real-time data. You just go there and you'll get the price. So this is not the price, it's actually the value. Okay. So this is value or fair value. We just call it value. Okay. So when I say value, I mean fair value. We take it like that. You don't have to repeat fair value. Okay. So value. Now this is value. And now why is it subjective? Now think about it. When what is actually known here in this model? Okay, what is known?
D0.
D0. Very good. Okay, this we know. This is objective because we know what the dividend was. There's no need to argue about it. Okay, but what is unknown?
The growth rate and expected rate of return.
Growth rate, yeah. So there is growth rate of dividends is unknown. What else is unknown?
So both of them are unknown.
What is both?
The return
Growth
also is unknown.
Yeah, so return. So K required return on equity. So cost of equity, okay? We call this the cost of equity. Remember the term? Okay. You remember that? Cost of equity?
Yes, sir.
Yeah. So this is the cost of equity. KE is the cost of equity. So understand that these are both unknown. Okay. And both unknown, both are uncertain. And this is why you see, why did I write this? All likely to have different answers. Okay. So if I just tell you, okay, use the Gordon growth model to do a valuation, I give everybody an exercise, and you're not allowed to talk to each other. Okay. So you use the Gordon growth model to come up with a fair value of Zomato. Okay. It's very likely that everybody's figures for G is going to be different, and everybody, and of course, there is not even a D0 for Zomato because they have not paid a dividend. But we can do this exercise even for a well-established company that is paying dividends, like say JP Morgan, okay, a big bank which is paying dividends. So if you do this exercise, it doesn't matter whether it's Zomato or JP Morgan, it doesn't matter. Okay, to illustrate the point as to why I said that value is subjective. Okay, so if I give all of you an exercise, lock you all up in different rooms, can't talk to each other, then the G will be different for each person, most likely, and KE will also be different for most people. Okay, what is the model that we use? Just again, refreshing all you learned in first year, second year, but basics of finance. What is the model that we use? The most commonly used model for arriving at the cost of equity?
CAPM.
Correct. CAPM, right? Capital asset pricing model, where the cost of equity is equal to the what? Just refresher work. Right now we're doing
Risk-free interest rate plus beta into market premium.
Correct. Market risk premium. Okay. The correct term is market risk premium. Okay. So cost of equity is derived as using the CAPM as RF plus beta into RM minus RF, and RM minus RF is what is known as the equity risk premium. Okay, or the market risk premium. So that's how. So that's the capital asset pricing model, which is used to derive this KE. But the problem is capital asset pricing model also. If we write this, now let's show you the interactions between models. Okay, KE. Okay, now you have to deal with my terrible scripting here. RF plus beta. Let's have the beta times RM minus. This doesn't work very well actually. So I have to do something like this. Anyway, let me just use third bracket. Okay. Then this is the right way to do it. Okay. Now we are getting it's refresher work right now, but as you can see, many of you are not very clear, not able to answer rapidly on the question. RM minus RF. No? So some of the stuff has been forgotten. So this is what I said is not acceptable. Your finance students, make sure all this basic stuff which I'm recapping it means it's important. Okay. I personally don't have a high opinion of this model, this CAPM, but it's commonly used, so you need to know how it is, how it's being used, and because in industry that's what people use because it's easy to. I mean, they've got some funny ways of implementing it, but that's what people do. So you've got to get used to what people are doing, whether it's conceptually correct or not. That's a separate matter. We'll deal with those issues later. So RF times beta into RM minus RF. This is how you arrive at cost of equity. Now, why am I saying? We'll come to the G part. So I'm saying first statement I'm making is value. This is the first statement I made is this P0 is not correct. It should have been V0 because it's a value model. It's a fair value model. Okay. So GGM is an example of a fair value model. This is what we call. This is how we use the language. GGM, example of a fair value model. All right. So here, a fair value model, as I said, value is subjective. Okay. Why is it subjective? Now you understand. If I put you in separate rooms and no contact, everybody's G is going to be different. Everybody's KE is going to be different. Why is everybody's KE going to be different? When you come to the estimation of KE, maybe make it a little bit bigger. So let's look at this. Yeah. Okay. So yeah. Now look at this. Now, why is everybody's KE likely to be different? Is this objective or subjective? RF? Yes? Why is everybody quiet? Vartika, let's ask Vartika. Is this objective or subjective? RF. When you're implementing the CFPM, is this RF objective or subjective? It's what? O for orange or S for Singapore? I couldn't hear you properly. Objective or subjective? O for orange or S for Singapore? What happened?
Sir, it would be objective.
Correct. It is objective. It is objective because you can see what the treasury bill rate is, right? You can see what the treasury bill rate is. So I'm going to use this excuse to give you another website which is good for collecting data. For you have to track all this stuff, right? Because you will be asked about this in your interviews, and you should know where to get data. So I'm giving you another website. Not loading properly. Anyway, I'm giving you this trading economics. So what you do, you go to a sub website like this, and for some reason it's not loading properly. Are you able to hear me? I hope I haven't lost my internet connection.
Yes,
So we can hear you.
Okay. So there's something wrong with this website. Okay. So why is RF objective? It's objective because you know what the treasury bill rate is, okay, or the treasury bond yield is, okay, at that point of time, the YTM, because you can just go to the data sites like this, and figure out what the RF is. This is not a problem. The problem is here. Okay, again, I should be asking you, but now it's pretty obvious. This is the problem because this actually should be, although when you implement it, they use all kinds of conceptually problematic shortcuts. That's why I don't like this model, because the implementation is done in a way which is totally different from what the theoretical specification of the model is. Okay? So that's why I don't think it's a good model. But people are just somehow implementing something because they want to feel like we are implementing a model. That makes them feel good. So, but it's very conceptually problematic. People do all kinds of historical rates of return, but the historical this is meant to be the future rate of return. Okay, so if you're doing cost of equity estimation for a 20-year horizon, okay, this is like 20-year horizon, then this should be the outperformance of the stock market. Actually, this is a market portfolio, okay, but we use the stock market index as a proxy. This is meant to be the expected excess return on this whole thing in the third bracket. Is the expected remember, future expected excess return on the market portfolio excess over the risk-free rate. Okay, 30-year bond yield you can find out. Okay, you can find out 30-year bond yield easily, but this is not known. What is going to be the return on the stock market index as a proxy for the market portfolio over 30 years? That nobody knows. That's just a guess. Okay, and that's why everybody's estimate of KE is different. Okay, another reason the estimate of KE is different is, what is another source of problem? In the difference we are doing all revision work, folks, but your concepts have to be clear. This is what I mean by when you're finance students, your concepts have to be clear. Another reason why it will be different is your betas are also going to be different depending on what is the data set you used. Okay, if you use like 1 year of data to calculate your beta, you'll get one value. If you use 5 years of data, you'll get a different value. You might have noticed this. Did you not notice this when you are doing beta calculations? That if you change the data set, the beta will differ. Yes? Anybody? Do you remember this?
Yes, sir.
Yeah?
Yes, sir.
So
Yes.
that's another reason. So please understand all this. So please keep your brains on, switched on when you're doing all this work. Don't just mechanically do it. When I put you in separate rooms, everybody will, and I maybe you don't even know the KE. I just give you the RF and I give you some, the excess return on the index over the historical data. But I don't put a constraint on you on how much, what is the data set you should, what horizon you should use to calculate your beta. So some people will use 5 years, some people will use 1 year, some people will use 10 years, and then all the betas will be different. Okay, so that's why everybody's KE is different. Okay, so that's why this is a subjective model. It's a fair value model, it's a subjective model. But more, so one is that the KE is going to be different, the discount rate. But more importantly, this is not such a big deal. I mean, if I, at the end of the exercise, if I look at the 47 different cost of equity figures, okay, from all the students, the variation in the estimates of KE is not likely to be that big. Okay. What is going to be very big is the variation in the very wide standard, very big, high standard deviation figures for the estimates of G, growth rate of dividends. This is where all the differences come in. Okay, so if you listen to the market reports, I've told you to listen to television, to market reports. Even in Bloomberg Technology, you'll find that now the tech stocks are coming out with earnings. Microsoft just came out with earnings, very good earnings. Amazon, all the tech stock earnings, big tech earnings are all fantastic earnings. Okay, Facebook also very good earnings, but the you notice the Facebook stock is just look at the very short term. Yeah, this is where the earnings came in. Okay, post earnings the stock dropped. Well, the numbers are very good, but the outlook is not so good because they're expecting user engagement. If the outlook is poor, sometimes the market will drop. You never know what the market is going to do. Okay, so the point is that so when you listen to all this, you'll see when you listen to these market reports, you'll see there's a wide variance, a wide variation in different analysts' opinions about what is likely to happen in the future. Some are bullish on Facebook, some are bearish. Of course, the best example for variation and subjectivity is Tesla. So if you look at Tesla, all now, 1 minute, I've got a call. Just hold it 1 second. Just give me a second. Okay, so so just 1 second. Let me just give me a second, okay? Hello. अच्छा मैम अभी the class नीचे है पढ़े कॉन्फ्रेंस ओके आफ्टर द प्री ट्रेनिंग अभी आपके हाथ ना पढ़े कॉन्फ्रेंस sorry about that. That was the doctor's receptionist actually. Okay, no, we don't want carrot browsing. Can you hear me? Am I back on the audio?
Yes, sir.
Okay, great. Sorry
Yes,
about the
sir.
interruption. Yeah. So Tesla again, if you saw, again, the movement is so dramatic after that. But around here in Tesla, it's actually, you could have seen a lot of differences in, if I go back here, around this time, okay? Around this time, before this dramatic rally began in Tesla, around here, there was a lot of disagreement on, some people were saying this thing is going down to 20 or something like that. Some people were saying this is going to 2000. Okay, so this Kathy Wood, I think her name is. So she's a big tech investor. She was actually among those people saying Tesla is going to 2000, and they're still bullish on Tesla. So you will see a tremendous variation in opinions. So this is why value is subjective. Okay, value is usually arrived at using, I mean, this is basically, you can say, the standard, pretty much the standard valuation model. Okay, you can replace this dividend with earnings. Okay, and you can put, it doesn't matter if you want to have a growth figure separately, because this is a constant growth model. So you may have separate estimates. You can make this into the earnings, and you can have different, you can just remove this and put in different estimates for earnings. First year earnings, maybe 100 million. Second year earnings, maybe 90 million. Third year earnings, maybe 450 million here. Fourth year earnings, something else. So whether you put it, these are, you can think of this thing as a return. Okay, a general expression would be a return. Okay, so this is an asset, and on this there is a return. So your return could be dividend, it could be earnings, it could be a project cash flow. Okay, it could be a royalty income. Okay, so HCL Tech might have bought licenses from IBM, and this is a transaction that I discussed a few years ago with the students. So it's all the same. Okay, all the valuation work that you have done, your project valuation. Let's use this time to understand that all valuation is the same. Look at the basic structure of this equation. That is always going to be there in every valuation exercise. So try to understand how all valuation is the same. You did projects. What is the difference? Project here, you put a project cash flow. Forget about this 1 plus G. Suppose you use different G's and you come up with a direct number. This whole, do the multiplication and come up with a number. So first year cash flow, second year cash flow, third year cash flow, and so on and so forth. At the end, you have salvage value for the project. Okay. In the case of the stock, you will have the terminal value of the stock. What will be the value of the stock at the using an infinite series calculation? But it's all the same. You see the basic structure. You will have in the numerator, you will have some return figures. It could be a dividend, it could be earnings, it could be project cash flows, it could be HCL Tech royalty income based on maybe $100 million worth of software licenses they bought from IBM. So the investment is $100 million. And then you have, so your NPV calculation, it's all the same. Just moving some terms around here and there. Okay, just some cross multiplication maybe, just some moving some terms from left hand side to right hand side. But the basic structure is always the same of valuation models. Okay, here you have this. So try to understand that. Okay, are you getting some idea of what I'm saying? Or am I talking Japanese? Are you getting some sense? Anybody?
So you are not talking Japanese.
Okay, I'm not talking Japanese. Good. So, so I hope you get a sense of what I'm saying. This is very important to understand because you have done bond valuation separately. You've done project NPV analysis separately. Then you have done stock valuation separately, but they're actually not separate. They're all, the basic structure is always the same. The fair value if you put on the left hand side, okay, or this can sometimes be set as the market price also in the case of bonds, where you assume that the market is fairly valued. Okay, so the market price is equal to the fair value, but this can be the fair value, and then you have how do you arrive at the fair value for any asset. Okay, so what I'm showing you here is that valuation for any asset, the logic is the same. You put in the returns that you will experience in each year. Okay, what are going to be the returns? And then each year's return, you PV it, present value it, using the appropriate discount factor, the discount rate. In this case, it is cost of equity because what are you discounting? Dividends. Who gets dividends? Not the bondholders. Dividends are only paid to shareholders. That's why you're using cost of equity. If this figure was operating income, remember balance sheet, operating income. Operating income means interest payments have not been deducted yet. Okay, when you do enterprise value calculations, operating income means that interest payments have not been discounted yet. So have not been deducted yet from the operating income. So when your numerator is operating income, this cannot be KE, it has to be WACC. Remember WACC? Yes? What is WACC?
Cost of capital.
Yeah, so that includes both debt and equity because in operating income, you have not deducted yet the interest payments. So therefore, this operating income stream belongs to both shareholders and bondholders. That's why when your numerator is operating income, the discount factor has to be the discount rate has to be WACC, not just KE. Unless, of course, the company has no debt, in which case WACC is equal to KE. Got it? This is the logic. Okay, so understand all this. So what have we learned today? Basically, that these are very important things. Okay, if they seem like we did not cover much, but whatever we have covered is like very basic and fundamentals of finance. Please make sure replay the video multiple times. Make sure you understand everything I've said. Okay, please understand these fundamentals. Price is objective, value is subjective. Okay, and why is value subjective? Because everybody will come up with different estimates, and there's no way to tell that Mayank is wrong and Ankit is correct. There's no way to tell. That only the future will tell us. Okay, so everybody's estimates are different. So everybody's estimates of value are different. Okay, so time for you to go. Okay, so what I'll do is so the class is dismissed. Okay, you guys can leave. Class is dismissed, and whoever has questions can stay back. Okay? So everybody else, people can start leaving, and if anybody has a question now, you can. Sanchit, you had a question. You get the first dibs. You were first in line for asking questions. Okay, so let me finish. Before Sanchit asks this question, I'll just briefly finish. So this is basically, so please remember that we learned why value is subjective and why price is objective, and we went into the details of the growth of the valuation model, the GGM, and I also showed you how all valuation has the same basic structure. So please remember those things. Okay, all these are very, very important points. And then the KE, you need to revise all this stuff. Yes, so go ahead, Sanchit.
Sir, I want to ask you that ki price is subjective. Is it? I get the idea that price is objective, but price is subjective. It is not a correct statement according to me. I just want to refute the statement of what Rahul has said.
Yeah. So actually, Rahul was not wrong. Rahul was not what it was wrong. It was a different kind. Rahul was talking about a different thing. Actually, he was not talking about the price. He was talking about, my question was whether price is objective or not, or subjective. But actually what Rahul said, the statement itself was not wrong. What he said was the process of arriving at the price includes elements of subjectivity. Okay, I'm rephrasing what he said to make it very, very specific. But this is basically what Rahul was saying, that the process of arriving at the price, at the market price, through the interaction of the actions of various investors, includes elements of subjectivity, because the decision-making process of the investors is subjective. You get what I'm saying, Sanchit?
Yes, sir. Yes, sir. Done, sir.
So Rahul was not saying that price is objective. He was not saying that price is subjective. He was talking about something other than the price. Actually, he was talking about the process of arriving at the price. So he was not wrong, but he is just talking about a different thing.
Okay, yeah. So sir, we can also say that the price is a blend of some subjective and more of objective.
No. It is not a blend of anything. It is objective. Price is objective. Okay. So price. So just I hope you're clear about that, because Rahul was not talking about price. Okay. Rahul was not talking about price. He was talking about the process. Like ask him what is a laddu, and he said a jalebi is this. So he's not even describing the laddu. He's describing something else. Okay.
Okay, sir.
Okay, got it. Got it. Okay. So you're clear that then we'll go to Mayank. Are you clear, Sanchit?
Yes, sir. I'm pretty much clear.
Okay. Yeah. No. Not pretty much clear. You have to be 100% clear. Please make sure.
Yes, sir.
Yeah. 100% clear. Okay. Okay. So make sure you understand everything. Yes, Mayank.
Well, in CAPM model, like we are just taking in Gordon growth model, we are just taking dividends into the consideration. But shouldn't we take the selling price also into the consideration? I think selling price we are not taking because we are taking dividends to be growing infinitely.
Correct.
Infinite.
Correct.
But like obviously no investment is there for infinite. So shouldn't we make it as a 10 or 15 years and then take in selling price also into the consideration?
Yeah, if you remember how you would have implemented something like the DGM, the way we do it is typically we don't forecast cash flows to infinity with specific numbers. Okay, or we don't forecast dividends for. So what we do is, in this case, of course, you have an infinite series. This is a little easier. But if you go back and you start doing earnings, for instance, okay, if you do earnings, typically, if you remember, there is something called terminal value. In the last term is something called the terminal value. Okay, so there again, you use the convergence of an infinite series, okay, and use that formula, and the limit of a convergent infinite series. To be specific, what we have is a limit. The structure is basically, it leads to, if you remember your APGP, okay, and your series, then this is the convergent infinite series. That's why it has a limit. So in the limit, you get that figure of either it's d by in this case that it is going to be what is the formula? I think r minus g by no, sorry, the d by r minus d0 by r minus g. In this case, it is going to be ke minus g. Okay, so that what is that formula that you get? That is actually the limit of the infinite series. Okay, so you're right that you have to, in practical implementation, and let's take a simpler example of where you're actually predicting earnings. So you don't take the trouble of you specifically predict earnings, because you don't use a simple thing like a constant growth rate. Okay, so you want to make more specific projections, and you do those things for maybe 10 years or something like that. And at the end of 10 years, you do a terminal value calculation, which is, again, ultimately a stock has to be always valued as an infinite holding, because the stock has no maturity. Okay, so in that you will have one expression, which one term will be the terminal value, which is again using the infinite series limit of an infinite series. You will figure out what is likely to be the again, assuming here you're going to assume that the market the stock will be trading at its fair value, because even for the terminal value you're using a fair value kind of logic. You're not using a price logic. Okay, you're not using a price logic. Like if we go back to all, okay, what is the price of Tesla? $6.99. You're not using a price logic here. You're using even here in the terminal value, you're using a fair value logic. So you'll have to assume that in this, you're assuming that after 10 years, the stock will be trading at its fair value. And that is what you take as the terminal value. But you're right that in practice, we will have to deal with this concept of terminal value. This is clear, man.
Yes, sir.
Yeah. So yeah, you will have to do that. So in practical implementation. But so look at all the assumptions. Okay, when you do that, so remember one thing, very important, not just to mechanically remember the models, but also to understand the assumptions built into the models. So one important assumption is that when you see how subjective these models are, that's why I just say the models are a bunch of assumptions. Okay, models in finance, okay, not in physics or aeronautics. We can Mars pinpoint accuracy. So that's a different ballgame. So here it's a bunch of assumptions, because you're assuming, please be careful here, please understand this clearly here, that when we are doing this, when we are implementing a model like this, and we are doing a terminal value calculation at the end of 10 years, and we are using a certain terminal value based on this kind of methodology, what we are assuming actually is that at the end of 10 years, the market price of the stock is going to be equal to its fair value, which we estimate using this estimate. And again, in that estimate of fair value, there is subjectivity. So you're assuming that the market price will be equal to that fair value. So that's a big assumption. So it's full of assumptions, actually. So if you see here also that, I mean, this implementation of this, full of problems, conceptual problems, because this is meant to be a future rate. This RM minus equity risk premium in the conceptual model, it is meant to be a forward-looking figure. What will be the excess return on the stock index as a proxy for the market portfolio over the investment horizon in the future? Who knows what it's going to be? But what we do is we look at the historical outperformance and we plug that in here. That's ridiculous, actually. If you look at it conceptually, it's ridiculous. So it's fraught with problems. But people just implement it. They just overlook all these things because they want to implement them. They want to say to themselves that I'm using a model, and more importantly, say to other people that if you're using a model, somehow you're like you have attained like, some level of nirvana or something like that. So if you're using a model, And if you're just subjective, then maybe you're not so good. This is the bias that we have, right? So please understand all these things. It's full of assumptions in these models. So don't just blindly use the model. Understand the assumptions and understand, try to assess whether the reality is actually conforming to your assumptions. Is this clear? Long answer actually.
Yes.
To Mayank, but these are the things that you need to learn actually. That's why I give you. You notice I always give you very long answers because I want you to understand the full context. I mean, I can just give you a short answer, but that means it's not really sensitizing your mind to the richness of the context. Okay. Yeah. Okay. Any other question? No.
No.
Okay. No. Okay. Fine. Then I'll just stop the recording, and then I'll. So just once again, I'm repeating, folks. Please remember, still need to have more participation. When you have any problem, anything you don't understand, notes are not clear, okay, can't see this, can't see that, can't understand something, you have to tell me, okay? I can't read your mind. So you have to inform me and then I will deal with it, okay? So we'll stop the recording now. And hopefully, are you sure you want to stop? Yes, stop recording.